Welcome, everybody. This is Craig Lemoine. Welcome to today's Land and Everything Else podcast. I have the honor of sitting here with John Breen. John is a little bit of everything. He's helped design curriculum for our department at University of Illinois. He's an accountant. He works with RSM. So, John, thanks for being here. If you could introduce yourself a little bit, we'd love to know more about you.
Sure. So I'm John Breen. My full-time job is with RSM. I've been here 30 years as of last September. Had a career prior to that with H&R Block for about 13 years. In the middle of my RSM career, I took a sabbatical, went to work for Cargill for about 4 years as a kind of a local controller for them, and then I came back to RSM. So I focused predominantly on farmers. So that's a big chunk of my client book. Then I also do, I teach H346. I've been doing that for 10 years now. So that's kind of my part-time job. And now I'm, branching out into doing things like this.
Yeah, and ACE 346 for everybody, that's a income tax class, junior level. And so John's been teaching that with a slightly twist to it, I would guess.
Correct.
Compared to like a business school.
Yes.
Well, John, I'm really excited to talk to you today. I know you've just completed an awful lot of work on a graduate class. It's going to be called the Tax and Regulatory Policy of Alternative Investments, which aside from the heavy name is actually a lot of fun. And I guess we'll start our conversation there. What did you get out of that journey of putting that together and helping create that content?
Well, really for me, it actually made me go back and relearn some code sections. Because I think when you get in this business, you've been doing it as long as I have, you just know kind of what they are, but you don't necessarily refer to them. And so I worked with Donovan Sanchez on writing a lot of the scripts. And Donovan was definitely my wordsmith, because I could get in and write the technical stuff, but he made it where it was more palatable to the listeners. But that was a big piece for me, was going back and kind of just relearning, the code sections and digging into some of that and making sure that what I've been telling people the last 30 years is correct.
Well, how are you doing?
So far, so good.
Right?
Yeah,
so
far, so good.
That makes me happy. So I kind of wanted to start a conversation today, to that end. This program, this tax and regulatory policy, it's going to be neat. So for our listeners, part of it is going to be on Coursera. So anybody can jump on in and listen to that content, right? You can actually watch those classes once they're done. And then the other half is actually a graduate class at U of I, which hopefully we can talk John into teaching. So we're going to twist his arm a little bit and see if we can do that together. So we're really excited actually to launch that. It'll be 2024 and we're pumped when that comes out. Not sure when in 2024, but somewhere in that time frame. So John, when we talk a little bit about our audience for this podcast, starting out is a lot of investment advisors and brokers and insurance agents and that kind of intermediary, right, who works with consumers. And we've seen more and more in, I would say, both a low interest rate and inflationary environment. We've kind of seen a move to alts. Right? It's been a very popular move. There's a lot more about alts at conferences and events, and we talk a lot about alternative investments. When you look at that CFP space and you're doing, tax returns for all sorts of farmers, just to kind of start the conversation, I want to get in the alt space. I'm talking to you, John. What are some options I have of kind of diversifying away from traditional stock and bond and open into mutual fund investments?
Well, so farmland is a big one.
Right.
Now, granted, I work with farmers, so they're basically illiquid with their estates because a lot of their estate planning is tied up in farm ground. But we're also seeing a lot of investors that are getting into it, and some of that was because it's a steady income stream, especially with the cash rent environment that we're in today. So I think that's a lot of what I see is people, getting in and they're buying some ground, and even at $20,000 an acre, they're still, making that investment, to get a pretty nice return on their money at a pretty much a guaranteed rate. Some of the other things that we see, we do a lot of, or not a lot, but some hedge funds where clients are investing in hedge funds, a little bit of private equity. That's really more done out of our larger offices as opposed to like Central Illinois. But we do have some clients that have, invested in private equity funds. So those are probably three of the bigger ones. But for us, here land is a big piece of that.
Let's start with land, right? We'll kind of jump into that for the alt standpoint. The idea, I'm a consumer, and I'm deciding, okay, I've got, hypothetically, got a 401k. It's got S&P in it. It maybe has some bonds in it, right? Some sort of products there. Maybe I've got an IRA rollover. Maybe I've got some non-qualified position. But at some point in the game, I say, okay, I've got all these stocks, I've got all these bonds. I want to invest outside of stocks and bonds. And I look at land, I drive by, right? There's something about, I can see it, right? It appeals to me. When you see non-farmers make land purchase, right? Like I'm going to go ahead and buy something and invest. What do you see when you help them through that process? What decision-making points do you step on there to say, okay, where are we going to look? How are we going to do it? What team do you need to build? I'd love to get your thoughts on that.
Well, I think what happens a lot of times is a lot of people that invest in land buy a lot of land. That's what we've typically seen. And so
Okay.
they've usually got people that are out looking for parcels for them. The other thing that we see a lot is somebody maybe sells their business. They sell a big building, they
Sure.
sell whatever, and they want to do a 1031 exchange into something.
Okay.
Well, farmland is great for that
Sure.
because you can exchange into the farmland. You've got kind of a steady income stream. We've also seen people, more and more currently going into Delaware statutory trusts as a means of 1031 exchanges. But a lot of times that's what we see, where somebody has sold something, they don't want to pay tax on it now, they want to defer that gain,
Okay.
and they'll look at farmland. And a lot of times they're going to rely on a farm manager or something like that to help them figure out what parcel should I buy and how many acres and, at what value and all those things.
So let's dig a little bit. Delaware Statutory Trust. Tell me more about that. For our listeners, maybe haven't heard of that, or that's going to be new to them.
It's going to be new to most people.
Got it.
Is what I would tell you. We've kind of seen them come about because I've got a client right now that they owned, a lot of apartment buildings.
Okay.
And they sold those, and they wanted to get into something else that was not necessarily an apartment building. So with the Delaware Statutory Trust, they're set up as a trust. And so what you do is you buy an interest in that trust, and it qualifies for Section 1031 treatment.
Okay.
So 1031, for people who don't know what that is, typically that's been like land swaps. So you come in and you say, okay, I'm selling my piece of ground or my business or not so much my business, but more of my building that was in
Sure.
my business.
The physical piece.
Yeah, the physical piece, and I want to go trade that for some other property so that I can defer my taxes. That's ultimately what we've seen. So with Delaware Land Trust or Delaware Statutory Trust, that basically is allowing them another vehicle to go in and buy into this. It is set up kind of like a limited partnership.
Okay.
In such a way that you're not going to have a lot of control over it. So they're going to decide, here's the investment that you're buying into. And then, it's kind of locked in terms of you don't have a lot of say in terms of what they do. You do get quarterly income amounts from them typically. So it is a nice income stream that you're going to get. So if that's what you want to do and you don't want the actual active management anymore, Delaware Statutory Trust is a good way to do that.
Okay. And are there different managers of Delaware Statutory Trust? Multiple ones to pick from?
Yes, there's a lot of them out there. and it is fairly new. I mean, we haven't really run into these except for within the last probably 2 or 3 years. And now we're seeing more and more of them.
And to that end, then, there needs to be some discernment between managers, or is it more the asset type you want?
I think it's probably a little bit of both.
Okay.
A lot of times it is the asset type in terms of what are the assets in this one that that makes me want to go buy that.
Sure.
And obviously they're being marketed, so you're going to get some sales literature that's going to say here's the what we're structuring, here's how we're going to do it. So there's a lot of that out there. It really has only kind of come into being within the last few years.
So it allows me to take advantage of 1031.
Correct.
Right. So I can keep deferring the
Right.
gain from, apartments, office buildings, real estate, whatever it is. But it also is more hands off.
It's more hands off. The other thing is typically people would like to defer into limited partnerships or partnerships. You cannot do a 1031 directly into a partnership interest.
Okay.
That's why the Delaware Statutory Trust, because it's set up as a trust, allows you to do that.
Got it.
So it's somewhat limiting, but it does give you another opportunity if you decided, well, I don't want to do land or I don't want to do another building. I can invest into one of these statutory trusts where I'm kind of pooling my money.
Sure. So maybe a tiny bit more diversification.
Yes.
Okay. So there's a
Yes.
big advantage to that.
Yeah.
Probably more costs, but more diversification
Right.
at the same time.
Yep.
All right. So that's fantastic, and thank you for bringing that to the audience. I'm sure they'll enjoy that. A lot of googling's going on right now. I'm positive of that. um, when you're working with, I want to buy a farm, right? Let's say I'm dead set on it.
Yeah.
All right. We kind of have used this hypothetical in other episodes, right? I'm a physician. I'm a surgeon. I've got extra income. But do you find that we're buying land for the income, for the cash flow? Is there something romantic about why people buy land too? Like, is there's this kind of emotional piece, or do you find it's pretty much like we're going to buy this, we're going to get those returns? What are your thoughts as you talk to people about land purchase?
I think sometimes it is emotional. So
Yeah.
so it may be grandpa farmed,
Right.
and so that's kind of in my DNA, and I want to kind of honor my previous relatives, by doing that. So a lot of times that's what it is. Sometimes it's just, hey, land is a very safe investment.
Okay.
It's not going to go anywhere.
That's true.
Odds are we're still going to be able to farm this land 100 years from now. It may not be growing the same crops, but we'll be doing something with it. So I think that's a lot of the issue. But I think a lot of times it is an emotional attachment where we've got some farming in our background, and we want to honor that.
When you work with somebody that, let's say myself, right? I've never owned land. I've never farmed. But if I went out and let's say I inherited some money and I went out and had $1 million and bought a parcel of land, what advice do you kind of have on the front end for me?
Well, I would probably advise you not to go out there and drive the tractor.
Yeah, that's probably a good idea. I don't see that going well.
Yeah, and for most people that don't
this.
Yeah, that don't have a farm background, that is not what you would want to do. I think the key thing is, after you've bought the land, then you've got to figure out, do I want to be a crop share rental or do I want to be a cash rental?
Walk me through those.
Okay, so crop share basically means I'm going to share the income and I'm going to share the expenses of raising the crop.
Okay.
And that's really more old school investors. So we see a lot of actual farmers that decide they're going to retire. They say, well, I've got this ground. I'm not going to actively farm it anymore, but I don't want my tenant to have to pay cash rent because I hated cash rent.
Got it.
And that's the most common example. And so they'll come in and say, okay, we're going to share this. So it's 50-50 is how it's usually set up. We share half of the proceeds of the grain, and then we share half of the expenses. And typically it's set up that I can sell my own grain as the landlord whenever I want. I can take advantage of whatever marketing strategy I want. I can rely on my tenant if I want to do that. But there are a lot of landlords that say, no, I'm going to go market my own grain.
Okay.
So you have more control
Sure.
from that standpoint. And you also can weigh in on, well, I think we should put in this much fertilizer. I think we should do, I think we should put tile down.
So you're not farming, but
you're making decisions.
You're still, so you need to have a certain wisdom.
Yes.
To be able to do that properly.
Right. As opposed to cash rent, where it's basically, okay, I'm going to give you my ground and you're going to farm it, and there's going to be some provisions that say you have to do these various things, probably keep the soil level at a certain level, and then you're just going to pay me cash rent for it. So that's where I'm going to get a steady income stream, which is attractive to a lot of people that are exchanging, especially. Whereas with the crop share, you're going to have some cash available to pay those expenses.
So from a tax standpoint, I would guess crop share is more complicated, right?
Yeah, it's definitely more complicated because if you have a cash rent situation, you've got income from the rent, you're going to be paying some taxes on the ground, and you're probably going to have some insurance expense. That's about the extent of what you have. The other thing that's interesting about that is, from a tax perspective, is qualified business income deduction.
Okay.
So if you're cash rent, you don't get that.
Interesting.
And the qualified business income deduction is 20% of the net that you make.
Yeah.
So if you are a crop share, then you could possibly qualify for the qualified business income deduction. So that's a big factor there. I mean, you're trading, some things with it because you're going to have to put out more expense.
Well, and you probably need to know a little more about what you're doing.
Yes. Yeah, because a lot of times you see with the crop shares, it's somebody that does have a farm background. Or you hire a farm manager to manage that for you and pay them a fee.
Right. So that's interesting on the tax standpoint, because that 20% is could, meaningfully matter over time, especially over a 5 or 10 or 20 year period. That's going to add up.
Well, and that assumes that it stays as part of, the current tax act, because, that's going to sunset here in a few years. So that may have a bearing on what people decide to do. If you don't have a 20% QBI, they may decide, hey, cash rent's looking a little bit better.
Because now we don't have necessarily the same decision making and capital risk on the front end, right,
Correct.
that we would on the back end.
Yeah.
So I'd like to kind of take from a tax standpoint, right? We're having a good convo there, and move over to maybe, private equity hedge funds a little bit, right? Because we can buy land directly,
Right.
or we can buy, private products that buy the land for us.
Sure.
Right. So
Yep.
we can invest in a hedge fund, and maybe that hedge fund then can manage land investments and holdings, and perhaps even it's a little more liquid because those hedge fund shares now, they're not as liquid as an open-ended mutual fund,
Right.
but there'll be times where I can get in and get out.
Correct.
When do you see that hedge fund decision being made over the land purchase? Or, I mean, is it personal preference, or do you see that it's skewed one way or the other?
Typically,
I'd just be interested to see that.
Yeah, typically I don't see that many hedge funds that are strictly land.
Okay.
At least with the investors we have.
Sure.
And some of that I think is because we're located in central Illinois and we got a lot of farmers.
Yeah.
Typically on the hedge fund side, I mean, they're in them for various reasons. I've got a couple clients that, they made quite a bit of money with a startup company years ago, and they got into some hedge funds, and they've, kind of stayed with those for the last 10 or 20 years. And they've performed well, for them. But we typically don't see people going into hedge funds kind of as another means to get at real estate, at least when it comes to farm ground.
Sure.
Now, maybe for other types of real estate, like if you're investing in something that would buy, let's say, a bunch of Walgreens,
Okay.
we do see that, where people will make those type of decisions and go with those. But I don't really see too many, at least in this area, where they're doing it because it's going to let me diversify my land.
So as long as we're on hedge funds for just a minute, you've prepared thousands of tax returns over your career.
Yeah.
Can you walk me through the differences? I own the Vanguard 2050 fund, right? Let's say I own it, and for some reason I've decided to put that in a taxable portfolio. Okay. Versus maybe a hedge fund, right? Comes into the year. How are those going to be taxed differently? I'd love to just get your accountant perspective here.
Yeah. So mutual funds, those are typically just going to generate dividends.
Right.
So you're going to get qualified dividends. You're going to get maybe some pass through of some foreign taxes. I mean, it's a very simple input into the return. When you get a hedge fund, what I typically tell people is you've just added probably a few $1,000s to your prep fee, because a hedge fund, their K1s are probably about yay thick. And so what they have is they'll have the page one, which kind of breaks out all the income numbers.
Okay.
Then they have a bunch of statements after that. And a lot of times that will modify those numbers that are on the front page. So at RSM, we actually have a spreadsheet that we have to drop in the K1 numbers so that it tells us where should we be reporting all this stuff. There's a lot of foreign related things. Sometimes there will be additional foreign forms that need to be filed. Typically, they're involved in multiple states. So you may have multiple state filings, which also increases your fee. So what I typically tell people is if you invest in a hedge fund, your return just got immensely more complicated.
So if you're a DIY tax person, hedge fund's probably not for you, right? That I feel like that's a horrible decision.
Yeah.
Okay, good. Well, it's good to see the difference between those elements. And then when we get into sort of private equity, I don't know to the extent you have experience with that end of things, but where would you put private equity on that tax pain scale?
Private equity is similar to a hedge fund.
Okay.
Because they're both private funds. And so you're going to see more complex input. Depending on that private equity fund, it may be not quite as varied as the hedge fund, but it's still going to be something that's going to add additional items to your return. The other thing it's going to do, more than likely, is cause you to have to file an extension. And this is the thing that we've seen people before, run into problems maybe with an advisor. Because if the advisor doesn't tell them, look, we're going to put you into this investment, you're probably going to need to extend your tax return. We've got some people that absolutely hate extending returns.
Really?
They believe that that's going to cause them to be audited because they're extending their returns. If you actually look at the numbers, you are statistically less likely to be audited if you extend than if you don't.
Huh.
And that's been the case for a long, long time. So that's one of the things that I've seen people come in and get mad at their advisor because it's like, well, he didn't tell me I was going to get a K1 for this investment and that this was going to cause me to, have to extend my return. So I usually tell most of the advisors I work with, hey, just make sure your client understands if you put them into this, this is how it's going to work. And typically, as long as they're forewarned about it, then you don't have those issues.
So you're working with somebody down the road. Let's say they've gotten into farmland, they've gotten into hedge fund, they've gotten into private equity. It's estate tax time, right?
Mm-hmm.
Somebody passes away in the family. When you look at estate tax returns and estate tax issues, when we talk about farmland,
Mm-hmm.
right? We'll start there and can make our way to some other things.
Right.
We can talk about farmland from an estate tax standpoint. And what can we do with farmland maybe that we can't do with stocks and bonds in an estate tax return? Or is it all like valuation wise and
Well, the thing about farmland, is going to be it's a very illiquid estate.
right?
So I have a farmer that passes away. It's very illiquid, and so you've got a scenario where you've got to figure out, okay, the heirs are either going to have to do a couple of things. They're either going to have to sell some of the ground, or they may have to take a loan out on the ground in order to pay the estate tax.
Right.
You also have to look at not just the federal exclusion, but also the state. So
That's where things get complicated, right?
yeah, so as an example, Illinois has a $4 million lifetime exclusion. The federal government has, right now it's about $13 million. So that's a huge difference. We
It
can have
is.
people that are below the federal exclusion, but for Illinois, the $4 million is pretty easy to hit. So that's one of the things that we talk to them about. I mean, typically irrevocable life insurance trusts, we have a lot of farmers that set those up
Sure.
to cover, because that keeps the proceeds from the insurance out of the estate, and it gives them some cash so that they can pay, or the heirs can pay, whatever the estate tax might be.
How do you get them past paying that premium? You just show them the model?
Well, typically, yeah, you kind of look at, all right, what we sometimes do is say, okay, your estate is let's say it's $20 million.
Okay.
And we'll go through and say, okay, here's what your tax would be. You need enough insurance to cover this.
Yes.
And yeah, they may balk a little bit at what that insurance is going to cost, especially if they're older.
Right.
But when they look at it from that standpoint and they say, well, I don't want my ground sold.
Yep.
And I don't want my children to have to pay this big estate tax. So yeah, let's go ahead and pay the premium.
'Cause I think that's an important takeaway for our audience today is understanding that, states are going to be different. And Indiana and Iowa and all your Midwest states and your southern states, everyone's going to have a slightly different estate or gift element to it.
Yep.
And I think they're not always paired federally. I think that's important to understand. When you get into a world where I may have bought this farmland in the 80s or 70s or inherited it in the 80s or 70s, and now it's worth $20,000 an acre. Right. Like that appreciation is massive.
Yes.
And I think that cannot be overstated as far as land and everything else goes. Right. You can have some huge gains built in.
Sure.
And it doesn't necessarily mean you've got a huge cash flow to go with it, but you've got the underlying wealth is certainly there.
Right.
And I think preparing, consumers and clients for the estate and inevitability comes into play
Right.
to that end. What about when we're looking at, okay, so I own, farmland and I pass away. The fact that it's a liquid, does that help at all in valuing it? Or is it valued flat out, this is what you could get at auction and that's what we're going to value it at?
Typically, it's going to be valued at, well, I mean, usually what happens is you get somebody to come in and do an appraisal on it.
Got it.
And they're going to say, you get an expert in that field, and they come in and say, this is what it's worth. That's typically what you're going to use. Now, we also see people sometimes who will create LLCs and put the farmland in them.
Okay.
And the reason why you do that is because from an estate planning standpoint, maybe I want to start gifting away
Shares of the
some of my interest in the land, so I gift away my shares in the LLC at a discount.
probably easier to do.
The only
control wise.
Yeah,
right?
the only downside is you do have to get a valuation on the business. You can't just go get an appraisal on the land and say, well, that's what the partnership is worth. You actually have to get a valuation on that. So one of the little tricks that we use for that is sometimes we'll say, okay, let's get a valuation that's done at the end of the year.
Okay.
Do one gift December 31st,
All right.
do a second gift January 2nd.
Interesting.
I can use the same valuation, so
For
I don't
both
have
gifts,
to pay
yeah.
for that twice.
So that saves you a little headache.
It does, and then it also allows you to use your annual exclusion numbers twice.
Right.
'Cause
so
I
you
do-
use them in December, use them in January.
Correct.
Skip a year, December, January again. Right? So
Exactly.
you kind of have an every other year
Right.
situation going. Does that same strategy work with the Delaware Trust we're talking about earlier?
No, it really doesn't with a Delaware trust because you can't get other people into that. So it's set up as a trust. They're not allowed to take in additional members. So you really can't do, as much of the same type of planning that you can inside of, just being your LLC that you're going to get down to your heirs.
I love it. So I've got two more questions for you
Okay.
today. The first is you're working with a consumer, let's say an affluent consumer. They were not raised a farmer, right? They want to get involved they want to invest beyond stocks and bonds. Land is interesting to them, maybe private equity, maybe hedge funds. What team do they need to put together to do this well and not hurt themselves? Who should be on? Who should be on the team? Like that's I think an important takeaway for everybody.
Well, I think the thing about it is you've got to get somebody that understands farms. So you may need to talk to some farm managers, people that actually manage these things, to tell you, because one of the key things is going to be what type of ground is it? Is it kind of Class A ground where you're going to get great yields? Is it timber ground? Is it, what is it, to help you figure out what you really want to invest in? There are some people that will invest in something that's more timber heavy because maybe they're a hunter.
Okay.
And maybe they say,
and
hey,
they want the utility of that, right?
Yes, I want to be able
Yeah.
to hunt that ground.
Right.
And the fact that I can still get some income off of it, great. And the fact that if I can 1031 something into that ground,
Even better.
even better. So I think a lot of it is you've got to get somebody that understands, farming, if you're going to go into farmland. You want to have an accountant that understands farming. You need an attorney that understands farming that can help you draft documents, or if you think about LLCs or think about doing some other things like that. That's got to be a big part of your team, are people that are knowledgeable in the area.
And I can't stress enough to the advisors and the brokers and agents listening right now, that team, on the front end is going to be worth its weight in gold.
Right.
As opposed to kind of help your client making the purchase, and then on the back end going, oh, this maybe wasn't the best idea. I shouldn't have gone to that auction, and now here we are.
Yeah.
So I appreciate that. And the last question we ask every guest on Land and Everything Else: what advice would you give to a financial advisor, a insurance agent who's talking with clients about alternative investing? I would love to get your thoughts on that.
I think the key thing is, I'm going to reference back to what I said earlier, and that is, don't put your client into a product that they don't understand or that's going to cause a change in how they're filing their return. Because what we see a lot is, I had a guy a few years ago that he bought a whole bunch of oil and gas partnerships. And he came in and he had like 30 of these. And I said, okay, well, your fee just tripled, because this is what we're going to have to do, to get these. And he finally got out of all those. But that was a case of he didn't really know what he was getting into. I'm not sure if he's still with his same broker or not. But it was a case of I had to deliver that news, and he was not really aware of what he had bought, what he had gotten into. And I think the key thing is you just need to tell him, if you're going to get a K1 for this, you need to advise the client, you're getting a K1. This is not a dividend like what you've been used to in the past. You're getting a K1. You're probably extending your tax return. And you need to probably go talk to your accountant now so he can get ready for what's coming. Yeah.
That's fantastic advice. And thank you so much, John, for your time and experience. We really appreciate you on our podcast today.
Not a problem.
Thank you.